Okay, let's dive into some real financial drama today. We're talking about the 1997-98 Asian crisis.
A really pivotal moment.
Absolutely. I mean, think about this. Just 2 days after the Hong Kong handover, boom, July 2nd, 1997, the Thai baht gets devalued. Chaos.
Yeah, and for investors like Overlook, it was just incredibly sudden, violent, really. Their portfolio was down. What was it?
A shocking 49.1% by the end of 97. Lawrence himself called it surreal madness.
And that experience, that sort of trial by fire, is really central to the book we're looking at today, Richard H. Lawrence Jr.'s The Overlook Model.
Right. It covers, what, 37 years investing in Asia?
Exactly. It's about surviving these huge crises, obviously, but also about the investment model they built to actually thrive long term.
Okay, so let's unpack that crisis first. Lawrence talks about this weakness. He calls it Asia's bankruptcy bomb. What exactly was that? What set it off?
Well, the core problem was so many companies were holding unhedged U.S. dollar debt, lots of it.
Unhedged meaning they just borrowed dollars without protecting against currency swings.
Precisely. So imagine you're a Thai company. Your currency, the baht, goes from 25 to the dollar to, say, 50 to the dollar almost overnight.
Oh, wow.
Your loan in baht terms just doubled instantly. So companies that maybe looked okay on paper were suddenly facing bankruptcy, just like that.
That's brutal. So
Yeah.
you need incredible foresight or just plain grit to survive that.
You did, and there are stories of that grit. Lawrence highlights Kun Surachai Sirivalap, the CEO of Thai Reinsurance.
Right. What did he do?
Well, he basically prepared for things to get worse, positioned the company carefully, and the result, he compounded net profits at 37.3% for 6 years, right through that period.
That's incredible performance in that environment.
It really is, and it speaks to having the right balance sheet, the right management. There's this great little anecdote, kind of gallows humor.
Yeah.
Lawrence apparently joked he'd end up flipping burgers at McDonald's if Tire ever reported a down quarter.
Oh.
And Kun Surachai shot back, well, I'll be right next to you making the French fries. That's confidence born from, real discipline.
That discipline, it wasn't just luck, though. It comes from their core philosophy, right? The Overlook model.
Exactly. They boil it down to 4 key things. Pretty straightforward, actually.
Okay, what are they?
1, superior businesses. 2, management with integrity. 3, bargain valuations. And 4, a long-term investment horizon.
Simple concepts, but hard to execute, I imagine. Especially that superior businesses part. What does that mean in practice?
Well, what's interesting is it doesn't have to be glamorous. They give the example of Unisteel technology.
Unisteel. Never heard of them.
Right? They made screws, basically specialized high-spec fasteners, the tiny screws used in hard disk drives.
Okay.
And apparently they even secured Apple's early iPods together, so seemingly mundane stuff.
Screws doesn't sound like a high-growth tech play.
Not at all, but it was a focused, incredibly well-run business, and the returns, spectacular. An average return on equity of 37% over 6 years.
37% ROE. Just to clarify for listeners, ROE, return on equity, that's basically how much profit a company makes from the shareholders' money invested in it, right?
That's it. And 37% average is just phenomenal. It really proves that these, simple, focused businesses can be amazing investments.
Okay, so philosophy is one thing, but actually getting those results to investors requires discipline in how you run the fund too, right? The book talks about TWR versus CWR.
Yeah, this is crucial. TWR, time-weighted return, that's the performance number the fund advertises. Like, we were up X% last year.
Got it.
But CWR, capital-weighted return, that's your actual return as an investor, your personal internal rate of return. And sometimes there's a big gap, a discount they call it.
Why would there be a gap? If the fund did well, shouldn't the investors do well?
Well, think about it. A fund has amazing performance. Money floods in. But that huge influx of new cash can actually dilute the returns for everyone, especially if it forces the manager to buy assets at higher prices or stray from their best ideas.
Ah, okay. Chasing performance, too much capital too quickly.
Exactly. It's a common trap. But Overlook did something pretty unique to avoid this.
Which was?
They put a legal cap on subscriptions. They literally limit how much money they'll accept.
They turn money away.
Yeah.
Even if it means lower management fees for them.
Yep. They deliberately capped their asset growth. It ensures that the outperformance they generate through their investment picks actually gets delivered to their existing investors. It aligns their interests perfectly.
That's unusual. And takes serious discipline.
It really does.
So wrapping this up, what's the big lesson here for, for us watching markets today?
I think the core lesson from that crisis and from Overlook's approach is that bear markets are the ultimate test. Survival of the fittest, as they say.
Right. The weak get washed out.
Yeah, the old winners, often built on shaky foundations like too much debt, they become the new losers. And the
Wow.
new winners, they emerge from the wreckage because they had that discipline, that integrity.
And the key thing to remember, I guess, is that bear markets don't last forever.
Exactly. The historical average globally is what, about 12 months? So they end. And if you've managed your affairs with discipline, if you're still standing at the end,
Then the opportunities must be incredible.
absolutely. Those post-crisis opportunities can fuel years and years of really strong outperformance. Surviving the wreckage is tough, but the reward is being there for the recovery. That's the challenge, really. Be
Hmm.
ready.